Welcome to Changing World, New Opportunities. This podcast is brought to you by the DC Investment Forum and hosted by me, Louise Farrand, and my co-host, Dave Whitehair.
This season, we're talking to the UK's leading master trusts. Millions of members and people in the UK now rely on master trusts for the future of their retirement finances. And we were interested to know how master trusts are investing and what the future holds.
In an uncertain world, how are they managing risk? And what's next on their agendas?
The DCIF's mission as a whole is to shine a spotlight on topical DC investment issues. And you can learn more about our research, follow us on LinkedIn, and subscribe to the show at dcif.co.uk.
Hi everyone, and welcome to this episode of the DCIF's podcast. I'm here with my co-host Dave Whitehair. Hi Dave.
Hi. And we're joined by Ben Lewis. Ben is head of Mercer's investment DC workplace proposition.
Hi Ben, great to have you here with us. How are you?
Yeah, it's great to be here today.
Great. And can you tell us a little bit about your career path to date? Like what's brought you here?
Yeah, absolutely. So I studied economics at university, and as part of that, I had the opportunity to do a work placement here in London as an economics assistant at the Treasury. And it was a really interesting time in the world. We had the outgoing Labour government moving to a Tory government, and it was very interesting to see the sort of winds of change happening in real time. So the whole government just shifting overnight, the civil service shifting in its priorities to support the new government. And that really sort of developed this interest in financial markets for me. Post-university, I secured a graduate scheme at Louise banking group that was really finance focused. So I ended up doing a lot of accountancy. And it turns out I hated accountancy. So got myself out of that after about a year and moved across to Mercer. And that's been a happy home for me for the last 14 years or so. And so been working primarily with pension schemes for my career at Mercer. Began working with defined benefit schemes predominantly. And I've pivoted to a role that is more defined contribution focused over the last few years. So I've spent lots of time working with clients looking for solutions in lots of different forms. So from those who want advice to what solutions. Today, my focus is developing the investment proposition for Mercer's master trust primarily, and the other DC solutions vehicles that we have for clients. And the focus really is making sure that we deliver a great investment solution. It's making sure that we can deliver for members at all stages of the journey, so that effectively members achieve really good investment outcomes in retirement.
Amazing.
Perhaps a good place to start, Ben, is if you could give us a helicopter view of Mercer's kind of DC investment journey, kind of the asset classes, the phasing. That'd be a thing with us. So.
Yeah, absolutely, yeah. So we made some changes to the investment strategy over the last few years, and we use target date funds to deliver it to members today. We really like target date funds because they make it really simple for members to interact with, and it means we can make changes under the bonnet in a future-proofed investment arrangement. So those target date funds effectively mean that a member who joins the investment arrangement today at age 20 could be in it through to age 80. It continues for 15 years beyond retirement for a typical member. The investments are primarily equity focused for a younger member, so just under 90% invested in equities. And as members approach retirement, we start to de-risk. And by the point of retirement, members are about a third in equities today. We have introduced a private markets allocation, which is coming through for members over the next few months. And we're really excited about that. It's pretty growth focused and it's designed to fill a role for those younger members who need that engine of growth to try and drive really good retirement outcomes for them. And we're really focused on making sure that the clients that are using the Mercer Master Trust have a really premium experience, who want to deliver great returns to members, who want to listen to what our clients and members want from us. So for example, we recently launched a Sharia investment proposition to effectively deliver a broader suite of options, investment options for Muslim members, because we saw a community that was underserved and that needed more support from an investment perspective. And I think that sort of underpins the ethos of our strategy. We're trying to deliver a great investment solution to all cohorts of Mercer Master Trust members and make sure the investments are really pulling their weight.
Amazing. Wow, there's a lot to talk about that. I'm sure I'll come back to some bits, particularly private markets perhaps. But first, it's funny, since we recorded these podcasts, started recording them late last summer, I've been saying there's a lot going on in the world and it feels like more and more is happening in the world. But I guess the question is kind of more pertinent now than ever in terms of investing governance and how you've evolved, if at all, if it's anything you changed in response to all of the interesting times, shall we
Yeah.
put it tactfully, that we're living in. Have you changed anything, or do you kind of see this as like short-term noise and you're trying to kind of look to long-term? Like,
Yeah. No, we certainly feel the busyness of DC right now.
yeah,
It's really interesting. When I am sort of coming through the ranks of Mercer, DC was always sort of referred to as a relatively don't I use the praise dull, but dull place to be, where not much change, everything was passive, and things sort of ticked along. And it's really been quite a pace of change over the last few years, and that's been really notable in the team that I work at. So we've doubled the headcount of the team over the last few years to try and face off against some of that pace of change that you're seeing, and make sure that we're properly resourced to deliver really good solutions for our clients. I think the trustees really acknowledge that there is a lot of change happening here, and they seek views, both from internal specialists at Mercer, but also external advice. So they've engaged the likes of LCP over the last few years, Hans Robertson, to provide advice to them to help guide some of the thinking and make sure that they are fully abreast of what best in class looks like and how they can keep driving that pace of change from an investment governance perspective. But I think you're absolutely right. We need to stay on the case with continued evolution that we're going to see in investment arrangements over the next few years. And that requires us to be nimble, because we need to have the right resource. We need to be able to pull in more where we need it. And that's why, for me, working at a firm like Mercer, where we have a big global DC footprint here, we're the only DC master trust here in the UK that has an Australian superannuation scheme, and that allows us to pick some learnings from different areas of the globe where we have other arrangements that are ahead of us on their journey. Maybe they've already implemented private markets, maybe they've already gone through something like BFM, the value for money exercise. And we can learn from that, and we can build on it here in the UK.
awesome.
One of the areas really interesting in your views on, Ben, is how you think about diversification, whether that's kind of at overall asset class level or even within some of the key asset classes you're focused on. And, as mentioned there, your experience from kind of the Australian superannuation market must be particularly relevant here as well.
Yeah, absolutely, yeah. And that feels particularly relevant today, given everything that's going on in markets. So we effectively have a sort of two-layered process at Mercer. So, for DC members, they have really long time horizons. We could have members that are in the growth phase of this default for decades. We need to think in those kind of time horizons when we're thinking about building a portfolio. So the bedrock of any decision around either diversification or the broader investment strategy has to be that strategic view around, what the right asset classes are for members over the long term, taking that very long-term view. And the investment arrangements are reviewed on an annual basis to review that strategic asset allocation, though we have the flexibility to be a bit more nimble if markets justify it. So for example, during COVID, we took a look back and said, right, things have changed markedly in a really short time here. What does that mean for strategic asset allocation? Should we be making changes off the back of these developments? We overlay that strategic asset allocation with a shorter-term dynamic asset allocation position, and I think that's where we start to see some of the more tactical positions coming through. So taking a view on markets over 3 months to 3 year kind of period, and that's where we see some overweights, underweights, different allocations in the portfolio to try and add a bit of value to portfolios. So, for example, today we see a little bit more value in government bonds, specifically here in the UK actually, relative to high yield bonds and corporate debt, where spreads are a little bit less attractive, and trying to make sure that where we are using those diversifying assets, we're using them appropriately, and not all of those diversifiers are going to help you when you need it most, depending on what's going on in the investment landscape at that point in time.
I guess I was going to ask you about like long-term versus short-term noise, and you touched on the pandemic, and I guess I just wondered whether you see the war today, the US Israel-Iran war, as kind of akin in size to the pandemic in terms of a geopolitical crisis, or do you think it's more about a kind of ruption that is more of a kind of let's keep calm and carry on type situation?
Yeah, it's a really interesting one, and I think if you read the headlines of the FT or any other paper, you would think the world is sort of falling apart here. It's really important, I think, to zoom in on what that has actually meant for financial markets over the last few months. So I've been speaking to a number of clients in recent weeks, and it's been positive to go out there and say, listen, you're reading some scary things in the papers, but the reality in financial markets today is that it's sort of relatively contained. We're not seeing huge drawdowns in equities. We're not seeing members' pots decrease in value materially. Yes, things are volatile, and yes, we're seeing some ups and downs. But the vast majority of DC members will have seen their pot sizes increase really markedly over the last year. So, most seeing double-digit returns. And I think that's that's a key acid test at DC is members who log in, either frequently or infrequently, are they seeing pot sizes increase or decrease? And when they start to see them decrease, that's where you might start to see a little bit more interaction from members. And we did try and get ahead of it in that we know members that are clearly reading the same headlines we are, and so might have the same concerns, and have armed the help desks with some information that effectively starts to get to that point you mentioned around the keep calm and carry on doing as you were. Trying to get people to think like long-term investors, trying to encourage them not to take knee-jerk reactions, because history tells us, and COVID is a good example, if that's not necessarily going to be in their long-term interests.
Brilliant, thanks.
One of the other big themes in our market right now is consolidation. To what, if any, extent is kind of consolidation, the impacts of that having any bearing on how you're thinking about investment on Mercer?
Yeah. So it's a great question, and obviously you'll be aware that we have acquired another master trust over the last couple of years, and so Mercer purchased Cardano, and with that came the Now Pensions Master Trust. So we now have 2 master trusts within the Mercer DC Solutions business. From our perspective, we see that consolidation as being a big positive. We clearly have a bigger DC footprint here in the UK, and we have more assets to put to work in new areas like private markets. So we've recently made initial commitments to the private markets vehicle that I mentioned, and they're across both the Now Pensions Master Trust and the Mercer Master Trust. So being able to bring that scale helps deliver a better solution for both cohorts of members. And having £500 million to play with day one gets you a better deal from fund managers than having less than that would do. So from our perspective, a real positive on that front. I think the other aspect that we're interested in is that when we purchased Cardano, it came with some direct investment capabilities. And one of the things that came out in the pension investment review, and that is effectively one of the driving motivations behind the sort of reach towards mega funds, is trying to work towards that in-house scale, looking at DC Master Trust bringing some of the investment arrangements back in-house. And we think that's interesting because it leans into that capability that we now have within the business, and we're looking at whether we can make that work well for DC members and deliver better long-term solutions for them by using those in-house capabilities.
Interesting. And maybe we'll talk a bit more about that, because it feels like there's something on the DCRX agenda this year actually as well, is to talk about private markets and kind of better long-term relationships between asset owners and asset managers. So interesting that you're also looking at that. But tell us a bit more about the private markets allocations that you've made recently. Like, what kind of private markets are you invested in now?
Yeah. So the initial allocation is being made in June of this year for the Mercer Master Trust. The Now Pensions Master Trust have gone in to the private markets vehicle last month, and so we now got money in the ground, which is great. And initial investments in the process of being made. What we think about the private markets vehicle, there's sort of 3 key tenets of the philosophy that I think are worth mentioning. We've tried really hard to make sure that we're focused on growth-focused private markets assets, and there's clearly a spectrum of the different types of investments we could use in that world. We want to focus primarily on private equity and infrastructure equity, because they are, I expect to be the highest returning elements of the private markets universe going forward, and effectively can have the most beneficial long-term impact on member pots, we think. We have also looked at how we think about working with third-party fund managers who can bring complementary skills. So I've worked with Schroders Capital to launch the LTAF. We've worked with Future Growth Capital, who are the investment managers of the LTAF, and Mercer will also be contributing with the investment expertise that we have in-house and the solutions expertise that we have in private markets. And we think the blend of those 3 things, the access to co-investments to really drive the larger allocations to private equity and infrastructure equity, is a real positive for members. You get exposure to the asset classes that I think members need, particularly in those early years, but doing so at the right price point. And the third point is really around making sure that we are accessing the right components within the private markets vehicle. So most in the market are using long-term asset funds, LTAFs, as the primary route to access private markets. But you need to be really careful about how you manage those vehicles and how you structure the liquidity component within them in particular. So I think one of the sort of pitfalls that is easy to fall into is holding too much cash within those vehicles. Now, for a young member who's primarily invested in equities, if I do private markets and I deliver great returns there, that's fantastic. But if I've had to hold some cash along the way to help me get that back both to help their absolute returns and potentially act as a sandbag to some really good stuff that we're doing over here with private markets. So we've really tried very hard to structure the vehicle in a way that allows us to maintain equity exposure within the LTAF and make sure that we are continuing to hold those risk assets that members in particular need in those younger years.
Interesting.
Can we ask if you guys have signed the Mansion House Accord? And it kind of is so, what were your reasonings behind it? And similarly, if you haven't, what were your reasonings?
Yeah, absolutely. Yeah. So we signed the Mansion House Accord, who were signatories to the Mansion House Compact as well. And we see that as being a consistent direction of travel with where the trustees were looking to head around private markets anyway. We've been having discussions for a number of years with the trustees around investing in private markets. They were bought into the benefit that it could bring to members' portfolios. But we were working on a journey of making sure that we were getting access to the right asset classes at the right time for members. So when the Mansion House Accord came around, it really chimed with that direction of travel. We were looking at getting 10% plus in private markets in any event. The Mansion House Accord effectively aligns with where the trustees were heading. And for us, we see private markets as sitting within the default for all members. So we have one default investment strategy on the Mercer side, Mercer Smart Path, and that will be the default for all members. We're not looking to introduce other defaults, which again sort of links quite well with Mansion House, because it means that we are using the weight of our DC Solutions business to support the allocation to private markets for all clients.
One thing that we're really interested in at the moment is obviously it feels as though the main focus of private markets so far has been in the accumulation stage. Tell us a bit about your thinking when it gets to those kind of later stages of members' glide path towards and into retirement. How do you think about that at the moment?
Yeah, I think it's a really important point. So I think there is justification to focus on the growth stage in the first instance, and that has the biggest single impact on members' retirement income in later years. But there is also merit in looking at an allocation for members as they move into retirement and beyond. Some of those members are going to be invested for decades beyond retirement, so making sure that we are sweating those assets as hard as possible is really important. One of the active conversations that we have at the moment is looking at a vehicle that will effectively complement the growth phase long-term asset fund, which is going to remain growth focused. It's going to still be private equity and infrastructure equity focused, with another portfolio that is primarily focused on private debt for older members. So we see that as being a core part of the to and through retirement investment strategy. But I think it is, it's an interesting time for building an accumulation investment approach right now. The sort of elephant in the room is the default retirement is coming. The UK is going to go from, I think, delivering some really good support for members at retirement to being a market leader around the world. We're going to jump up the scale here. And I think the two things go hand in hand. You need to think very carefully about what you're planning to deliver for members as part of a default retirement solution, and make sure that your private market strategy for members and the approach to retirement marries up with that, and that it is a consistent framework and one that knits in really closely together.
Changing tack now and moving on to sustainability, another big theme in DC. Where are you at Mercer in relation to your sustainable investment kind of goals and targets? Whether that be specifically around kind of net zero, and kind of an interesting dynamic on this is kind of how are you tracking your progress, and is that starting to evolve?
Yeah, no, it's a really interesting point, and one that comes up a lot with clients. In that we have a 2050 net zero carbon emission objective, which is the sort of overarching carbon goal that applies to the default investment strategy. And so for the key funds, the key multi-asset funds in the glide path, they all have that 2050 objective. We've made really good progress against the 2030 interim objective that was set there, which was a 45% reduction in carbon emissions by 2030. So all the key funds within the defaults have achieved that objective already. So they're more than 5 years ahead of targets in meeting that. We continue to think about how we evolve the carbon emissions approach, how we, continue to work towards that longer term net zero objective. I think we have to acknowledge that some of the easier steps have been taken here. The low hanging fruits have already been taken. So we now need to think about how we continue to evolve the portfolio towards that longer term objective, and how we make sure that we continue to maintain that rate of progress that we've made in recent years. And the trustees are also thinking about things like nature. So we had a good session with the trustees at their recent investments focused trustee meeting in March, where we spent a bit of time digging into the nature-based impacts of the portfolio and looking at what the key contributors to risk were on that front, and starting to think about areas of focus for policies and targets in future. So I think that will be a really key area for investment trustees over the next 12 months, is how they evolve their approach on that front and start to take additional steps if they feel that's justified.
Yeah, it's really interesting. It feels like it's quite often observed by master trust that it's kind of easy. The first bit of the net zero journey, the low hanging fruit, is easy to collect, or relatively speaking anyway. But the next bit is going to be the really hard part. Is there anything you kind of wished for that were different? It must be frustrating sometimes feeling like, although you're obviously a big player in the world, there's only so much you can kind of do in some ways, and I certainly with how venture funds say to us, I wish, the governments were a bit more supportive, or regulators were more aligned, and that kind of thing. Is there any kind of plea you'd want to issue to anyone, or anything you'd really like to change about the system, the way it works at the moment?
Yeah. I mean, I think as increasingly large asset owners, master trusts, will have a
Bigger voice.
and they'll be able to have more influence on the markets. But I think we have to acknowledge that no single investor out there has enough of a sway to turn the dial on these things. So the trustees are very keen to make sure they're investing in a way that is aligned with what members want and how members want us to invest, and also that clients are coming on that journey with us. And I think we have taken some positive steps. So I think we should be proud of some of the journey that we've gone on to date. And continue to try and evolve that, right? I think we have to accept the wins where they come, try and seek positive change, and acknowledge that we have a responsibility as stewards of capital here to try and deliver more sustainable outcomes for members over the long term, that being a key priority for the trustees.
Cool.
Obviously, as a result of the enormous growth we've had in the market, comes with increasing amounts of kind of regulation and regulatory oversight. How things like the pension schemes bill started to impact the conversations you're having around the investment table at Mercer?
Yeah, it's a really good question. I think there's a lot on the table at the moment, and we know that this is going to be a busy year when it comes to DC pension scheme regs. So I think one of the interesting ones is around default retirement. So we've been having conversations for the last 12, 18 months around what we think the enhancement that we can deliver for members as they start to take retirement income will be, what we think the best version of that is. But the last little while has been a good opportunity to take stock of what we've seen around the world. Mercer has a footprint in Canada and Australia, and some markets where there are different solutions that are coming to market to help try and make members last more sufficiently through their lifetime. And I think learning from some of that stuff is really helpful. Equally, we've talked a little bit about value for money, and that's going to change the landscape slightly. There are some obvious concerns, I think, in the market, but it leads to investments hurting effectively, or DC master trusts being too aware of how peers are investing, and I think that definitely remains a risk. So whilst the regulations are well intentioned in trying to make sure that value is delivered for members, we need to be slightly careful of those risks. And speaking to colleagues in Australia, you can see how some of the challenges there have borne themselves out. So it is going to be a year where we're going to see things change significantly in the DC world. We're going to see regs continue to drive decision making, to drive action from DC master trusts. But I think having that sort of dialogue with our colleagues who, in some cases, have lived through the pain that we're about to go through, or have some more stories to tell us, has been really helpful in helping to guide us.
Brilliant. Well, we've covered a lot. Last few questions. What is next on your investment agenda? It sounds like there's an awful lot going on, but if you had to pick out one or two things.
Yeah. So I think one of the big ones for me is around that Shariah, the initial Shariah options I mentioned, and making sure that they land well with members.
Yeah.
So I mentioned that we launched the additional set of options. They're there. But one of the things that we need to work really hard on is making sure that members understand those, that we're working really closely with employers to make sure that lands with members. This isn't by launching any other self-select fund, because you're trying to target a cohort of members who might, see every bit of communication out of DC pension schemes and throw it straight in the bin because they think it's not for them. So it's trying to make sure that we can find the right voices with clients to land with that cohort of members. And I think that's really testament to the work that the relationship team do in building those contacts of clients and working with them to understand their businesses. I think the other one is really going to be around that allocation to private markets for members throughout the glide path, and making sure that we are continuing to evolve the investment approach. And having launched it, there's clearly a lot more to do here. So one of the things that we're very focused on in the coming months is thinking about how we can expand the opportunity set within private equity and look towards venture capital. There's a space that aligns well with members' long-term needs, delivers those high teens returns that members need in that early stage of the investment journey, but historically hasn't been a significant allocation for DC schemes. So how do we bring something that we think is a really good idea, but do it in a DC friendly way, and evolve the portfolio that we've probably placed that is designed to be that sort of home for these kind of assets.
Another future gazing question for you, then. What's one investment trend or technology you think will play a role in reshaping VC pensions in the next 5 years?
That's a really thoughtful one. Yeah. So I think the one that comes to mind, I guess, is the obvious of AI, right? I mean, we've recently been working with clients around rolling out an AI agent that is there to effectively be an interface for members that they can ask silly questions to, that they might feel that they don't want to ask someone over the phone or don't want to ask some of their colleagues about. That can be their sort of friend on WhatsApp if they have any middle of the night pension queries that answer in a way that is a little bit more robust than they might get from ChatGPT. Because we know that members are using ChatGPT and the other large language models, and they are going to continue to do so. So I think it's our responsibility to step into that space and meet members where they want to be met, because otherwise there's a risk that they're going to source information that is inaccurate or doesn't have the right guardrails around it to help them make good decisions. And I think that is one of those spaces where we'll see, an initial agent there that is designed to be helpful and can give you some support around how to make choices that are appropriate for you. But it will continue to evolve. And my sort of blue sky dream is that in future, I'm going to be able to say, right, what are the assets that I own as a DC pension scheme member within 10 miles of my house, and we'll be able to fed that to the AI agent and really help try and bring pensions to life for people. So feed it more around the investments to make it really sort of come to life for members, that they are investors and they do own assets and they are doing good for their local community.
Amazing. I just want to ask you one more thing, because you said venture capital, and it's just one of my pet subjects. I'm really interested in how you make them DC friendly like that. Can you tell us a bit more about your thought process there? Because in my head it's all kind of like, oh, crazy risky, but actually I think maybe my perception is wrong. So tell us a bit more about that.
Yeah, it's a really interesting one, because I think it is also been a risky area of the market. We can't get away from that, right? It is designed to deliver mid-teens plus returns, and that doesn't come without risk. But the younger members within this these arrangements, they're going to be invested for decades, and they can afford to take that long-term time horizon that one needs. The way that we need to build portfolios feels a bit different in venture capital, in that you have to accept that you're going to invest in some things that ultimately lose a lot of value. But the hope obviously is that you invest in the ones that make lots of value. So it's trying to approach the investment in a way that gives you the right opportunity, the right spread of investments across lots of names of venture, some of which will be the next superstars of the corporate world, some of which cyber buds. But to give members that right spread of assets that can try and help deliver those returns. I think the LTAF is really helpful there, and we've provides that jumping off point to make those kind of investments, by giving you that umbrella structure effectively that, allows you to be more nimble under the bonnet. And the fact that we have that relationship with Schroders, with Future Growth Capital, that gives us that vehicle that we can then use to evolve over time and look to venture as one of those spaces where we think there is value for members and something that can help enhance portfolios in future. I think there are potentially other areas beyond venture that one could look to, and I think having the right structure that is future-proofed is really important in the DC, because these are ultimately very long-term vehicles and need to be able to move with times. But yeah, venture is one that we think is exciting. It's definitely got the potential to deliver really strong return to members, but also to resonate with them. That's they're putting their money into potentially some homegrown companies that are fast growing and that might be the future corporate leaders that will employ them or their children.
Yeah, it's great to be talking about these asset classes in the context of DC and wind the clock back 10 years, and this stuff was seen so far-fetched, but we're getting there.
Yeah, it just shows how much progress we've made, doesn't it? Well, thanks so much, Ben. It's been a super interesting chat. I feel like I've learned loads and lots to take away. Thank you for your time.
Well, that's been really good. Thank you.
Thank you for listening to Changing World, New Opportunities, the DCIF's podcast.
Visit us online at dcif.co.uk, where you can read all our research, follow us on LinkedIn, and subscribe to the show.